Buy, borrow, die. Billionaires don't sell their stock. Selling triggers a tax. Instead, they borrow against it. Banks lend billions using stock as collateral at 1 to 2% interest rates. The loan is not income. It is not taxed. They live on borrowed money, repay loans with more loans, and when they die, their heirs inherit the assets at current market value. The original gain disappears. The tax bill disappears with it. This is legal. This is the most used wealth preservation strategy in American history.
The stepped-up basis. When you inherit an asset, the IRS resets its cost basis to the current market value. If your father bought Amazon stock for $10 in 1997 and it's worth $3,000 when he dies, you inherited it at $3,000. You owe zero tax on $2,990 of gains. Billionaire families have used this rule to transfer generational wealth without triggering capital gains for over a century. Congress has tried to eliminate it 17 times. It still exists. Opportunity Zone investments. In 2017, the Tax Cuts and Jobs Act created Opportunity Zones, designated low-income areas where investors can defer and reduce capital gains taxes by investing in local development. The intention was urban renewal. The result was that billionaires built luxury hotels, storage facilities, and high-end condos in technically qualifying areas. A tax break designed for struggling communities became one of the most efficient capital gains deferral tools available to people who never needed a tax break.
The Charitable LLC. Donating to charity reduces your taxable income. Billionaires discovered that donating to a limited liability company they control reduces taxable income and keeps control of the money. Mark Zuckerberg pledged 99% of his Facebook shares to the Chan Zuckerberg Initiative, structured as an LLC, not a foundation. He received a tax deduction. He retained voting rights. The money stayed under his management. A charitable donation where the donor keeps control of the donation is a different thing from a charitable donation.
Depreciation on everything. The IRS allows real estate owners to deduct the theoretical depreciation of a building over 27.5 years, even while the property increases in value. A building worth $10 million generates $363,000 in annual paper losses. Those losses offset real income. Donald Trump, Jared Kushner, and most large real estate families have paid minimal federal income tax for decades using depreciation deductions on assets that never actually lost value. The tax code treats buildings as if they are melting. They are not melting.
Puerto Rico Act 60. American citizens who move to Puerto Rico and spend at least 183 days per year there pay 0% tax on capital gains and 4% on business income instead of federal rates up to 37%. Puerto Rico is a U.S. territory. The IRS cannot touch income earned after establishing residency. Thousands of crypto millionaires, hedge fund managers, and tech founders relocated after 2012 when the law passed. The tax saving on a $100 million gain is approximately $20 million. The moving cost is a plane ticket and a lease.
The Augusta Rule. IRS Section 280A allows homeowners to rent their primary residence for up to 14 days per year and collect that rental income completely tax-free. Business owners discovered that their own company could rent their personal home for corporate meetings at market rate. The company deducts the rental expense. The owner receives tax-free income. A tax rule created to help Masters Tournament homeowners in Augusta, Georgia rent their houses for 2 weeks became a standard tax strategy taught in every accounting program in America.
Carried interest. Hedge fund and private equity managers charge a performance fee, typically 20% of profits, on the money they manage. This fee is classified as carried interest, not ordinary income. Ordinary income is taxed up to 37%. Carried interest is taxed at the long-term capital gains rate of 20%. A fund manager earning $500 million in performance fees pays the same tax rate as someone who held an index fund for 2 years. Congress has debated closing this loophole since 2007. It has not closed. Family limited partnerships. Billionaires transfer wealth to children by placing assets inside a family limited partnership and gifting minority shares. Minority shares are valued at a discount, typically 20 to 40% below market because they carry no control. A $10 million asset transferred as minority partnership interests gets valued at $6 to $8 million for gift tax purposes. The IRS accepts the discount. The family moves tens of millions across generations at a fraction of the taxable value. The discount is not fraud, it is a feature.